Well, we're back, but we're far apart once more. No longer in New York. I'm back in Phoenix for a couple more days, and I head away once more, and then you're in Houston. But welcome back to the show, another episode of the Lone Star Capital podcast with the CEO, co-founder of the firm, Rob Beardsley, and myself here, Craig McGrother, Director of Business Development, on a deal launch day. Can't talk too much about it, but happy Monday.
Happy Monday.
Yeah. Did you enjoy your weekend?
I did. Had a good weekend in San Diego. Back in Houston now, ready to grind, and then heading to New York this weekend. We'll be doing a culture index workshop the following week in New York. So everyone's getting back into town for that. So we'll update everyone on how that goes soon.
Yeah, well, I actually want to unpack that a bit on the show, and we didn't have that on the docket so far. But before we get into that, just want to remind everyone there is a very small amount of space left in our Dallas deal, Grand Riviera. If you were interested in investing in that one or learning what a partnership looks like, please reach out to myself, Craig McGrother Craig McGrother, whoa, Craig at LSCRE.com. If you have any questions pertaining LP investments or raising capital via the fund of fund structure or co-GP structure if you hit the equity requirement there, as well as if you're a JV group who's watching this. Thank you for watching this, and let me know if we can work together for you as a single check writer. Then, of course, as we went on in great depth last episode, we'll be hosting our summit event in New York City, September 15th and 16th, and we hope to see you there. We have a very, very solid group of individuals who are already committed to that with, first class content and also people to be networking with to make it valuable for yourself. It is an application process. We think many of you who are probably listening to this would fit into the group quite well, but of course we want to make sure that your experience is quality and who you're networking there is equally quality to make sure everyone gets their values worth. But with that said, let's get right into the episode. Well, actually, no, before that, getting into the topic, you mentioned culture index. So can you please walk through, why this gets you so excited, what's it about, and everything in between?
Yeah, I never knew that I would be such a personality trait nerd, but it does get me going, and it's an exciting topic that we'll be exploring further at this culture index workshop. So the point of the workshop is basically to understand our organization and understand the personality traits befitting each position, because obviously your role and the associated personality traits should and are different than my role or Kent's role or Sawyer's role. And so it's important to not just hire people because they interviewed well or you like their resume, you like their pedigree. It's also important to make sure that the personality trait matches to the profile, because here's the problem, and we all know this. If you're interviewing someone for any position and this person has a high sociability, they probably will interview better because they're a social person. They know how to talk, they know how to make you smile, they know how to interview. And
They can
so
charm
that
you.
you're going to come away from that interview going, yeah, they can charm you into getting an analyst position. And guess what? Their charm has no bearing on how good of an analyst they are. So
That
it's
only works
important to
well in
kind of
my role.
exactly. So it only goes so far, and hiring is such a tough thing. I think it's one of the hardest things that companies do. The statistics show that only 25% of manager hires are successful. Or let's just say hiring in general. Only 25% of hires are successful hires, as defined as basically being an A player, which is the holy grail. It's what we all want, right? Every employer wants people on their team that exceed expectations, that go above and beyond, and that can do the job better than you can. So anyway, that's culture index is adding another wrinkle to our hiring tool belt to allow us to hopefully get it more right more often. And but so as I've explained, each job description needs to have a corresponding personality trait profile. And that will help us kind of map out who works together and who works well in what position. And then when we're hiring for a new position, we screen applicants not just on their resume, not just on an interview and references, but also on their personality, on their culture index profile. So that way we can see how it matches up to what we're looking for. So yeah, that's kind of the high level of it. The other part, of course, because very similar to hiring is promoting. Promoting is basically hiring because you're hiring a person into a new role. So they might have been, let's say, an analyst, but now you're promoting them to associate, or just as a simple example, right? And so there's differences. Like, for example, at the property level, there's leasing agents, and a fantastic leasing agent is a salesperson. Just awesome salesperson. They can lease up a ton of apartments. And guess what? A good leasing agent gets promoted into an assistant community manager. But an assistant community manager has very little sales responsibility, and it's more of an accounting role. It's more of a collections role. They're the ones calling residents saying, "Hey, you owe rent." That's not a like that's so different. So it's important to understand that if you're taking a leasing agent and promoting them to ACM, do they have the character traits to actually be successful in that role?
Interesting. So, with that said, were you surprised by any of the, I guess, feedback you got from the tests that we took internally as a company to kind of sort out who was where? And were there any surprises, or did anything kind of fully make sense? Was it more of what you thought? How did that all land?
Yeah, they claim 90% accuracy on these tests. That's pretty good. But and so I would say mostly everything came back pretty much as expected. But there was a couple outliers where someone was reported as not organized, but in reality they seem quite organized. So there's just examples like that were a bit of a surprise, but by and large it's all pretty accurate, which is really impressive from a 10-minute survey.
Yeah, interesting. So, can you go through what you came up as and kind of the options that people get sorted into? And then we'll also go into what I ended into. And then I'd love to hear actually where Kent, the other co founder, of course, where was kind of placed. And then we'll go into the next subject from there.
Yeah, sure. And I'm still learning this myself, so I'm not an expert on the different profiles, but the way that they have it set up is there's 19 personality types. There's 19 profiles that they have. And there's yeah, I need to really learn this better so I can explain it better, but from what was told to me about me is there's five visionary profiles. There's like the daredevil, which is what you are. The daredevil is a visionary profile, right? Because you're a trailblazer. So it's like daredevil, trailblazer, enterpriser, and then architect. And I think there's one more, but I'm profiled as an architect, which is similar to the daredevil, is a visionary profile, which means that my strongest personality trait is I have a leading autonomy trait. So I'm very self-assured, confident, leader, uh, don't mind going against the grain, don't mind being a trailblazer. I like to be in control of my own destiny. So anyone who is going to be a visionary is going to have that strong above average autonomy, which you do, Kent does, I do. So Kent's an enterpriser, so he's also a visionary. So it's funny, all three of us are visionaries, and you need visionaries at the top of your company. You don't need too many of them, but you do need to, you need visionaries, obviously. But the thing is, visionaries, most of the time, what they have in that trailblazer feature, they lack in structure and organization. So your daredevil profile, it sounds like being called a daredevil sounds worse than it is, uh, because it's not such a bad profile. But what it means is you're have high autonomy and high sociability, and you're fast at picking up new concepts, but you're very disorganized. And that's the profile of a daredevil. So someone like you needs to make sure that you're matched up with people, surrounded by people who are strong organizational people. And you're going to find that salespeople are lacking organization, because what I've learned that's really fascinating is there's not necessarily bad personality types, except maybe one, which I can talk about. But every personality trait has a inverse. So you could say, well, shouldn't everyone, can't everyone benefit from being high sociability? You could say, yeah, but being low sociability helps you be more deliberate and introspective and thinking and kind of more philosophical, right? So there's a trade-off between being social, like an extrovert and an introvert, right? And the same thing with like deliberateness. You, for example, can think fast, move fast, and you pick up new concepts quickly. Well, that sounds great, right? But the opposite of that is you would struggle in a work environment or a situation where you had to do something over and over again with precision and attention to detail. That would be very hard for you, and that would wear out your battery quickly. But learning new things and talking to new people and doing new things, that's great for you. That's easy. So depending on the job, it might be a good thing, might be a bad thing, right? Like for example, me in my OCD way of living, I look at you and anyone else who's disorganized and I go, that is horrible. That cannot, how could that be a good way to be, right? Why would I hire anyone? I asked the culture index guy, I was like, why would I, if anyone comes up with a low organization skill or trait, why would I hire them? And he said, well, I'll tell you exactly why. And you know what he said to me? He said, the question you just asked is the type of question exactly someone with your profile would ask, right? Because
That
I
checks
come
out.
from such an organized mindset, you know? And he said, this is exactly what he said about you, because we were talking about your profile. He said, because Craig is so disorganized, the other way to frame it is he's so creative and fluid. And so when Craig hears no on an investor call, he doesn't even hear no because he's so creative, he's so disorganized slash creative that you're able to work around no, you're able to find creative solutions, and that is what you want from a salesperson. You don't need a salesperson to be very rigid and organized.
That makes full sense. I mean, I've heard people say no on the first blast on deals, and then they say yes later on, actually, because to your point, kind of rolls off and you just don't take it personally. And you come from an abundance frame, and things also change as well, too. I understand as well that sometimes people will say no out of knee jerk because you're programmed and trained to say no because you get so much garbage that you're actually not thinking clearly. And if you're thinking clearly, of course, you'd say yes to anything that I'm pitching and proposing to you, of course.
Yeah, of course. So yeah, so that's kind of a high level, some fun different tidbits about culture index. As far as just to finish about me, being an architect, I have the visionary traits, but I'm very low sociability and fast to pick up new concepts and very organized, which is the only visionary trait that has the autonomy coupled with the organization. Every other visionary trait is like you, which is high leadership, low organization. So I'm like the leader who's OCD, which is the unique one,
Uh,
which
This is
I'll
all
take it
this
as
is
a
all
compliment.
this is all very obvious if you know us and also just generally speaking our dynamic. You brought me on to do exactly what you didn't want to do. And it brought me on exactly to do what we're talking about, which is likely meeting and interfacing with people. It's not that you don't enjoy that, but it's, I guess, rare for you to enjoy it. And again, it's not something that you want to be doing, nor do you find it to be, I guess, pleasant. You want to do stuff that doesn't feel like you're working. And I know if it comes to modeling or structuring or kind of business creation ideas, things of that nature, org charts, you like that, you nerd out to it. Stuff like that to me is just so boring, and I'd rather die than do that. Being in spreadsheets, I'd rather die than do that. It sounds terrible. So there was a reason why I came on initially, and this all makes sense in retrospect even more. If you see how I keep my house compared to you, I am more comfortable with leaving a mess per se, which I don't think you would leave without everything being totally clean. I'm just a fly and go and I'll deal with it later person. Obviously I'm not reckless, but I have more of those tendencies than I would say you would, which is all very on par and on brand. So are you and Kent then, with that said, the same personality type, or are you slightly
We're
different?
similar. We're similar.
What
I'm more organized.
what's his superlative and what's your superlative? Yours is
So I
architect and
never, yeah, so his is enterpriser.
okay.
So basically what that means is he has, and we could actually share screen at another time. If people find this interesting, I would love to know, but we could, once we go through the workshop and I know more, we can revisit this and I can share my screen. I can show the different profiles and the charts and stuff like that. And also, I would love to have the culture index guy on the podcast, which
We
is
can do that
something that
next
we
week
can
with him.
do. Yeah, perhaps, yeah. If we can, yeah. So Kent basically has that leading, he's got that leading autonomy trait, leader, visionary, but then every other trait is just pretty average. And that sounds like, oh, that's a bad thing to be average. Well, no, not really.
It's
It can
balance.
be a good thing to
The
just be balanced, like
average
right in the middle.
average in this sense is not, oh, he's an average person. It's average from a skewing perspective. Is he social? Is he antisocial? He's just normal. Is he organized, disorganized? He's just normal, right? So just to clarify, Kent is
Right.
cerebrally speaking nowhere near average.
Yeah, that's for sure. But the interesting thing is through this process, I've learned that there's a difference between attention to detail and being organized, right? They're two different things because I actually wouldn't say I have the best attention to detail. I think one of my strengths is actually that I'm okay with done and not perfect. And someone with attention to detail is more so a perfectionist. So it's actually interesting because you can conflate them or you can misperceive them because you could come to my apartment and you see that not a thing is out of place and you go, "Oh, this guy's a perfectionist. This guy has OCD. He's got attention to detail." I don't actually. I'm very organized, which is different than being deliberate and being really attention to detail. So Kent, actually, I always figured him to be an organized guy, but he's actually not. He just has attention to detail, and that's why he can read. That's why he's a lawyer, and that's why he can read through contracts and he can nitpick and find the exact things because he's got the attention to detail to do that. Whereas I look at a contract and I go, "Oh gosh, I have to read through this whole thing and figure this out."
And then I look at a contract and I tell you to look at the contract because I don't want to look at the contract.
Correct. Yeah, that's what we have Kent for. So yeah, so
Right.
it's really fascinating to learn about people.
So it's very complimentary. So with all that's to say, what is the goal and the purpose on having them come to office and having everyone kind of connect? What are you looking to get out of that? And why was I so lucky to be excused and to stay in Oregon and not come back for that period of time? How did I get so blessed? Is it because you know me so well and you already know exactly where I fit?
Yeah, so the purpose of the workshop is to get the people that are involved in the workshop are people that are doing the most of the hiring, managing, and promoting, right? So you don't do much hiring, managing, and promoting, which is why I left you out of the workshop. But
Thank you.
the goal is to I would say our North Star would be to really hit the top grading goal, which, top grading is a great book I'm reading through a second time in our Lone Star Communities book club, which is a private book club that we do with with our entire company. And in top grading, it talks about how the business standard in our country is 25% of people you hire turn out to be A players, and top grading's goal is to get that to 90%. If any company, including ours, can get to that level of proficiency where we're hiring at a 90% success rate A players, we're absolutely unstoppable. I mean, that's the number one thing that we could do as a company.
So I guess for the remaining employees there, what are you looking to get out of figuring that out? Are they basically looking to sort everyone to know exactly where they need to be long term? Is it to kind of give you more clarity? You know what, I guess on top of that is most important.
Most important is, yeah, I would say building out a process for hiring is the most important thing that is actionable today. And then secondarily would be promoting and understanding the promotability of someone based on their performance and their personality traits and just having the right organization.
Very good. Well, I'm happy we got to kind of deep dive into that because it's something that you are very passionate about. On to other items that we're very passionate about, or I am more specifically, is some real deal articles, which we mentioned last episode, we'll be kind of incorporating more. So the first real deal article is something that you wanted to talk about, and there's two that we're going to be sifting through today, both very important, but was what is going on with tides. I think Real Deal reported that they're kind of getting more deals foreclosed in Texas. So I know you want to speak on this, so I'd love for you to lead the way and kind of unpack your kind of thoughts pertaining to this and kind of just the general feel that we're getting in the marketplace today.
Yeah, it's a bit more of the same, but it's fun to keep up with the latest drama and things like that. So I think across a few articles and just more news, Tides has is having 6 foreclosures take place in Texas and perhaps Arizona.
And Tides, by the way, is a
That's
sponsor, just so we're all clear, just to be more descriptive. They're one of the more name brands. They are a LA based sponsor. I believe they're in Beverly Hills. They're very young as well, very dynamic, just for a little extra context. And we'd love to have them on the show if they would want to come.
Yeah, that would be great. And yeah, I mean, it sucks to that they get singled out and picked on a lot, but that's because they flew too close to the sun, if you will, and they grew the fastest. They were the poster child. They were the it kids. They were two guys in their early 30s, left their corporate multifamily investment jobs, started Tides, and then went on in like 6 years to buy $7 billion, which I don't know if that's ever been done in history. So that is truly remarkable. And they built a very big business very quickly, and they made a ton of money for themselves and I'm sure for their employees. But now they're dealing with the aftermath of the high times, right? So it's they went high and now they're riding low.
The Tides are low now.
And yeah, exactly. The tide has gone out, and unfortunately, on some of their deals, they were in fact swimming naked. So I think the interesting thing is they're so big, they are approaching their problems from a big perspective. Like Blackstone, for example, has no problem walking away from a deal and giving the keys back to the lender because it's Blackstone. They're going to live to fight another day. Company like us, we can't afford to do that. We will scratch and claw and we will fight to the death to avoid a tragic situation like that. Tides is somewhere in the middle, right? They're not us, they're not small time, and they're not quite Blackstone, but for the multifamily space, they are basically Blackstone. And so they can handle, I guess this is at least their thought process. They can handle some foreclosures. And they're just gonna kind of triage the damage control and say, okay, well, these deals are too far gone. Let's just let those get foreclosed on. And then we'll focus on these deals and source pref equity and try to rescue some deals and whatnot. So it is a microcosm. Tides is a microcosm for the broader market because it's not fair to single them out because a lot of people are in, at least on some of their deals, in a similar situation as Tides is.
Yeah, and one thing I've thought about conceptually speaking is I think obviously right now from a cyclical perspective, you should be smart to be aggressive. Now, I'm not saying do anything frivolous and, stupid, but you're smart to be aggressive with capital deployment right now. These businesses are cyclical. This is the time that alpha is truly created. And if you buy and can size up deals right now, as rates get cut and then rents do increase over the next couple of years, you're going to make a boatload of money. But as we are in really high and chipper times, I really want to urge everyone to have a more capital preservation like strategy. When you've doubled your money up, it's very hard to double and double and double again, even with how sexy and close those numbers are on projections. It's smart at that time to actually have a more long-term forward-thinking approach. So as we do deals right now and we hopefully double up, investor equity on a, 3 to 5 year time horizon, on that next deal, I hope personally that we do something with a 7 or 10 year fixed rate debt term where, hey, whatever happens to the dollars here, it will be safe. And we have the autonomy perhaps to do a loan assumption opportunity where the sellers can, or the next buyer can buy a deal with a lower interest rate and we can exit because those deals are the deals that are probably hottest right now. Or just to be a little bit more forward thinking to make sure that you can make a very modest return, a solid return, hopefully, but you can hedge against a negative time like with what we're seeing right now. There's obviously many deals in bridge and floating rate debt, which has been well covered on this show and obviously in the news. And those are the deals that are struggling the most. So I think just from a philosophical perspective, I would really hope that we have investors who see the world similar to us and that are thinking about not just what your immense home run upside looks like, but what does a, strikeout look like, or what does your downside scenario look like? What does, running a chainsaw through the deal look like if rents regress or if, debt goes crazy like what we're experiencing right now?
Yeah, and also I think just an interesting topic, right? So these headlines are negative and they exacerbate the negative sentiment in our industry. And this is what perpetuates cycles because investors see these negative headlines. And like you said last week, our investors reach out to us and they say, "Oh, what's going on? How does this affect us? Does this create opportunity for us?" And so on. And these negative sentiment, this sort of news creates the negative sentiment that creates lower prices. Because if investors cumulatively have negative sentiment, then they will perhaps be willing to pay lower prices for assets, right? So that pushes down pricing, irrespective of the income of the property, right? Which is I'm referring to cap rate. And then if people start investing and then the headlines get better and people start getting more excited, then guess what? People are willing to pay a lower cap rate and they pay more money and they get excited about the deals. And then that's what perpetuates the cycle forward. So so long as human psychology exists, and it's not going to change because it's human nature, then cycles will exist. And you can't engineer out financial cycles because it's not a financial cycle, it's a psychological cycle. And so to that point, these cycles are debt fueled, kind of first and foremost. Like what people like to say is whenever there's a recession, if you look at the center of it, there's a lender. And but obviously it takes two to tango, a lender and a borrower. But the point is bridge loans got a lot of people in trouble like tides as far as what you see going on today. So a logical and emotional human would go, okay, well, if that's what just happened because of bridge loans, that means bridge loans are bad, so I'm not going to do bridge loans, right? However, where we find ourselves today in the cycle is prices have come down a lot, and we're at the beginning of the easing cycle. The Fed is going to start to cut rates, and that's going to kick off the easing cycle. And that this time is actually a great time if you want to. I'm not saying there's ever necessarily a good time to do bridge loans, but if you were to choose a time in the cycle to do bridge loans, you would do it at the beginning of the cycle, at the beginning of an easing cycle, rather than at the peak, at the top of the market cycle, when rates are at their lowest and when things are about to change. And obviously, we can't predict the future, we can't time the markets. However, you can vaguely, roughly estimate where you are in the cycle.
Without a doubt. And, thinking about the cycle where we're at with it, we're not going to talk about this just yet because we're going to go to the next article here coming up. But look how close the 2 and the 10-year are. And we're going to talk about, yield curves, what it means for it to be inverted, uninverted. But that's a very interesting indicator here. We're now within a 30 basis point delta between the yield curve being uninverted right now and the 2 and 10, which is very interesting. So more into that as well. But the next thing we want to talk about from an article, this is something that I wanted to pull up was this potential proposal, which who knows what this means now with the most recent news that Biden may or may not be running anymore. As of Sunday, there was a tweet that Biden will be stepping down. This is not political commentary. It's just, factual reporting here, of course, on the show. But with that said, he was talking about potentially having a rent cap to 5% for any landlord who owns more than 50 units across their portfolio. Obviously, we buy very large units, and this is zoned to kind of create more affordability in the market space. And kind of one thing that it makes me think about is if this does get pushed through one way or another, aren't we and our investors lucky that so many of our deals are naturally already in the affordable structure to start with, where we're already kind of handicapping our rents just generally? Also, the other kind of item I'm saying is it's just such a big shift, nationally speaking, into affordable structures as well. That, wouldn't you want to be with people who are navigating this and are on the forefront, perhaps before the government implements it, generally speaking? Because those are the people who are the biggest experts and the most savvy with it. If, a rents only get capped at 5% or unorganic rent growth or whatever it may be, well, that's great for deals like ours where, property tax exemption or property taxes get exempt for, ownership for ours and beyond. So that is true alpha in a marketplace that we're potentially providing for investors that get in. So what a great hedge to anyone out there who is a multifamily investor to be working with us even further.
Yeah, so I think it's funny how these rent control laws pop up and pop out, and they just kind of cycle back in and cycle out, just because on paper they sound like a good idea, but then in practice they're a very bad idea.
And
And
that's,
this one
yeah,
is just,
you go, sorry.
I was going to say this one's just the same idea. It's they're proposing a 5% cap on rent increases, and obviously that shifts the burden of inflation and of things happening in the economy onto the landlord. And there's really no other way to work around it. And the funny thing is it says the reasoning for this rent cap or this 5% rent increase limit is just for the next 2 years while the country figures out a way, while the country builds more units. Well, the funny thing is right now there's not a lot of places with rent growth in excess of 5% naturally anyway, because of that exact point, because we actually have built too many apartments in the last couple of years because of why? Because of free money and banks were providing construction financing and developers were building. Like Confucius says, as Sam Zell said, when there's money available, developers will build. And so that's exactly what happened. We got oversupply, and so now we're dealing with oversupply. The last year and the next year, we're right in the middle of it. There's going to be muted rent growth because of oversupply. So really, we don't need this measure right now. We're going to need it in a couple years, in a year or so from now, when rent growth comes back with a vengeance, because right now there's very few new developments happening. Land costs are too high, construction costs are too high, interest rates are too high, lenders aren't making loans at the same LTV. Also, rents have moderated and come down, so developers' pro formas are looking less attractive. A developer might look at an opportunity and go, well, I'm not going to build here because I can't make any money because all I can charge are $1,800 rents, and that doesn't work for me. I need to be at 2,200 to make money here. So for all those reasons, very few shovels are going into the ground right now for new multi. And that's going to cause the opposite of oversupply. We're going to have undersupply in, I'd say, a year to 2 years. So that's when we'll need the rent control. So it's just funny how they're just missing the mark and not understanding what is going on in the market today.
And I thought it was a really funny quote here. I'm trying to find it. The National Multifamily Housing Council also spoke out against the proposal and says it will not create a single unit while raising costs on its very residents. It's proposed to help. So it just goes to show that, by placing stuff like this, you're actually going to disincentivize those who develop and those who want to be in the space, which is only going to create a larger chokehold on the renter, and frankly, you got to think about this too. If we did just stop developing because developers were looking around and saying this is not where I can make money anymore, well, then people aren't going to be developing multifamily as it was before. And if you truly had a 5% steady climb on that for rent increases and whatnot, that would destroy renters to start with as well. So markets need to be efficient. If 5% rent growth, we're putting in a 3% terminal and we get pushback from big investors there, let alone a 5% annually. So on a 5-year hold, it'd be basically not just 25%, but 5% compounding, which as we know is larger. That is a massive, massive amount of rent increase there. But if you want to hedge against things like this and work with people who are, already implementing, rent control on their properties to a small degree to get maximum upsize while still preserving affordability, to speak with. But I just thought that was a very interesting kind of point there that, it is very interesting when government kind of mix in there. And I thought that 5% is still a pretty big number. We're talking about, a place going from $1,000 a month to, 1,050 to, probably, 1,100 plus a month, in a 2-year span. That's not a insignificant amount of increasing there.
Yeah, and this discussion doesn't mean that Lone Star Capital and we are anti-affordable housing or anti-government intervention when it comes to residential real estate. We actually are big proponents of affordable housing, and we do a lot on the affordable housing side. I think it's a really good space to be in and something that the country needs. The problem is people are struggling to find out the best way to do it. And the reality is very simple. The best way to help affordable housing is by just building more units so that there's more supply, right? That will offset the demand. And I know right now we're experiencing a short-term oversupply. However, in the long run, this country has a major housing shortage. We're down 3 million single-family units, and I'm not sure what the statistic is for multifamily, but there absolutely is a housing shortage, and the only way to solve it is through new units. So the government, rather than capping rents, should be providing incentives to developers to get new product out of the ground at affordable prices, because developers will always build the high end because they can get an ROI. If a developer can build and charge top of the market rents, $4,000 rents, that's going to pencil for them. But building for $1,500 rents, that's not going to pencil for a developer without getting a tax exemption or without getting a tax credit or some way for the government
Opportunity
to public,
zone.
yeah, to do a public-private partnership. That's exactly right.
And you said finally what I said, or what I was hoping you were going to say, and what I wanted to mention, but you just said it there, was public private. Public private is the way to get out of this and create solutions. The government does not do a good job when you give it dollars. I mean, as we saw, $8 billion created 9 chargers. I don't think I want to have them, with $8 billion build 9 units. So that's something to think about on that end there. Work with people who are pros, give them incentives one way or another. You will fix it a lot quicker there. And to your point, we love these structures. It's actually something we're very passionate about is the affordable nuances that, Kent, of course, does such a masterful job of sifting through. As a matter of fact, Kent and Brad Oliver, of course, a friend of the show and multiple time appearer on this podcast, our director of acquisitions, our beloved Brad and Kent are in Austin right now at an affordable conference, providing hopefully providing as much valuable as value as possible, excuse me, to our listeners and to our investors if they partner with us on deals. So, if you want to be on the cutting edge to find these unique structures, we invite you to do so and to reach out to us because we do think that is a great way to kind of create dollars, but also just from an investment perspective, there's so many sponsors out there who are only doing market rate deals and are doing value add deals, but guess what? Value add is very few and far between from a return on cost perspective right now. Meaning, you spend a dollar to get, X dollar back in return, right? So, we're very, very thoughtful with that. And we've kind of found that the affordable structure is a great niche that we want to play on top of the other, kind of, market things that everyone else does too. We can do the value add, multifamily down the fairway deals. We can buy deals at discounts. We've done both of those things this year and historically. We'll continue to do those and then we'll continue to do the affordable structure. So if we've got those three buckets to invest in and play with, and we maybe can splice on some development perhaps in the future, then we're really cooking. But just wanted to share that article because that has been something that has been passed around. It's been sent to me. We've been asking for comments. People have mentioned it. So happy we got that addressed here today, of course, on the show. Moving on next, I know Rob, you wanted to talk about bull and bear yield curve steepening. So I'm a little bit confused by that. So I'll let you kind of cook this up and have at it.
Yeah, so hopefully I can explain it well enough that you can understand, and that will be a good gauge for my ability to explain.
Additionally, it'll be good for to validate the daredevil status of my scoring because I allegedly can pick up concepts quickly. So let's see if I
That's
am able
correct.
to do just that.
Yeah, so in finance, people refer to changes in the in U.S. interest rates or U.S. Treasury yields as bear steepenings or bull steepenings. And so when interest rates when the yield curve steepens and it's coinciding with interest rates falling, that is called a bull steepening. So bonds are appreciating, which is why they call it a bull, because bonds are going up in price, but yields going down. However, the short end of the curve is going down faster than the long end of the curve, right? So rates are coming down, which is what's happening today. Rates are coming down. We all know that it's happening. However, what is most likely going to happen, what needs to happen, is the front end of the curve needs to go down faster than the long end. So that means the 2-year Treasury needs to come down to be below the 10-year. So that way we have an uninverted yield curve. It's the yield curve being inverted the way it is today is very unnatural, very unsustainable, and it's not how normal capital markets function. And the next part of this topic is swap spreads. This is a bit more of a complex topic, and I don't understand swaps very well, but obviously a swap in essence is a very simple contract where if I have, let's say, a floating rate loan, I'm a borrower of a floating rate loan, I could come to you and say, you know what, I'm paying this floating rate to my lender over here. Why don't I swap it and I'll pay you a fixed rate and you continue to pay my floating rate. So now I've hedged myself out of the float and I'm now paying fixed to a third party, which would be you, my hedge provider, right? So I'm entering into a swap contract. So the swaps are useful as a hedge if you're actually like someone borrowing debt on real estate, right? But also people use swaps as just an investment tool, and they can play the swap contracts to their advantage. I mean, because let's say the bank on the opposite side of the swap, they're in it not to be a nice guy and say, you know what? Don't worry about your floating rate. I'll pay you a fixed rate, right? They're doing it to make money. So the way that they make money is they assess, okay, if I'm going to take Rob's floating rate burden, I have to figure out what fixed rate I'm willing to pay so that I can still make money. And so how do they do that? Well, they analyze the future. They say, where are floating rates going? Because that's what I'm going to be paying. So like today, for example, if let's say floating rates today are 7 and then projected in a year to be 6 and then another year to be 5 and then another year to be 4, they could go, you know what? I know the floating rate today is 7, but I'm actually willing to swap and pay Rob a fixed rate of, let's say, 5 today because I know that I'm going to float down to 4 eventually. But you know what? I need to make a little money and I need to cover myself a little bit. So I'm going to offer 5.5. So I'm going to lose money now because I'll be paying his floating rate at 7. But as it floats down, eventually I'll make money. And hopefully over the average term, over the term of the swap contract, which let's say the swap contract is 3 years, but the fixed rate provider, will make money. So that's the essence of swaps. And so there's always spreads between the US Treasury yields and swaps. So, like for example, if you look at the 10-year US Treasury yield of, let's say it's 4.2-ish today, we need to see where are swaps today, and the corresponding swaps. And I believe Pensford has the swap prices. They do. So you can see this is really crazy stuff. 10-year Treasury today, right now, is 427. The 10-year swap is 374. So we have swap spreads right now, all up and down the curve. So any tenor treasury you take, 2, 5, 7-year, 10-year treasury, the corresponding swap rate is lower. So what that means, if I can understand the concept correctly, is that basically swaps is more of a reflection of what market makers, the actual banks in the market, are willing to play ball at, right? So basically what the market is saying is that the treasury market is wrong and that the swap market is right. And I think that is most dramatic and most understandable in the front end of the curve because right now nobody believes the Fed and nobody believes that where rates are today, as far as SOFR, is sustainable and that the Fed is in the way right now. The Fed is keeping rates artificially high on the front end, and the swap market's not buying it. The swap market is saying that no, these rates are going to come crashing down faster, and which means they're willing to provide a fixed rate at a lower price than if you were just to run the simple math on the average cost of the floater over the next few years. Because the swap market is thinking, no, these rates are coming crashing down. I'm willing to play ball at a lower rate. So that's a lot of interesting geeky math finance stuff, which I find personally interesting, but I only know it as on a surface level. But the takeaway that is really important is the fact that the Fed is creating artificially high rates on the front end, and that's not sustainable. The Fed will eventually cut and kind of go more in line with what is needed in the market. And hopefully we will have a re-steepening of the yield curve and this will be a bull steepening where rates come down, but the front end comes down faster, and now we have a normal yield curve. Now, a bear steepening is the same concept, but rates are going up, and the long end of the curve is going up faster than the short end of the curve, right? So rates going up, but the long end of the curve goes up faster, and now you have a normal yield curve. And the unfortunate thing about a bull steepening, which is what we are most likely experiencing, because we're not going to get to an uninverted yield curve by the 10-year going to 6%. The 10 years not going to 6%. That's not going to happen. Sorry for everyone who thinks that we should be underwriting 6.5 exit caps on our deals. It's not going to happen. 10 years coming down, front end of the curve's going down, and we're having a bull steepening. So that's good for finance and that's good for borrowers. But what it's bad for is it's bad for the economy because A bull steepening is a reflection of the economy, and that occurs when we have a recession because the 10-year US Treasury yield is a risk-off asset. It's a flight to safety asset. And so when the US has a recession, most oftentimes people buy bonds, and that pushes the yield of the bonds down, specifically the 10-year Treasury. So unfortunately, the market is predicting a recession. That's why swap spreads are negative, and that's the situation that we have. So it's good for borrowers, but it's bad. It's a bad sentiment about the overall economy, about the labor market and everything. And I know that people still have this inflation topic on their mind. It's out the window. Like Goldman Sachs's core PCE number is below 2% today. And if you dig up the real data, inflation is not what we need to be concerned about right now.
Excellent. And then yield curve, inverted, uninverted. Historically speaking, if the yield curve is inverted, that means we're going into a recession. For those who don't know what that means, can you just, in the most simplest term, break that down, please?
Yeah, so classically, the yield curve is referring to the 2-year US Treasury yield and the 10-year US Treasury yield. And in a healthy, normal functioning capital market, you would see the yield on a shorter maturity bond be less than the yield on a longer maturity bond. And that's due to the maturity, the term premium that exists, right? Because I'm sure I've given this example to you before. If I were to loan you money, or if you were to loan, if I were to ask you for a loan and I say, hey, I'll pay you back in a month, you probably would be like, hey, don't even worry about the interest. Like, I'll just, here's the 10 grand, pay me back in a month. You wouldn't even tack on interest because it's a month, it's too short. Now, if I said, okay, you know what? Let me borrow 10 grand from you for 2 years. Now you'd be like, well, I'm going to be without that money for 2 years. I need some interest if I'm going to do that, because that's kind of painful. So you're a friend, so you might charge me only 5%, right? You're like, hey, I can go make more if I invest it or if I do this, but you're a friend and Rob's risk-free. So he's going to for sure pay me back. So I'll charge him a risk-free rate of 5%, let's say. Now, what if I come back to you the next day and say, you know what, Craig, I want to borrow 10 grand from you for 10 years. You're going to be like, oh my gosh, I'm going to be without this money for 10 years. That's really not ideal. You're not going to be happy, right? So you probably charge me like 10%, 15% interest because
10% is the
you
number
don't
I had
want
in
to,
mind.
yeah, because that's a long time. So that's how normal, healthy capital markets function. And right, and as you see on the screen here, the 2-year Treasury is actually a higher yield than the 10-year Treasury. And that is what is called an inverted yield curve, where something's wrong. Why are people willing to lend on a longer term basis for less return, right? And that tells you a couple things about the market. It tells you that people don't think that the short rates are sustainable and that they would rather earn a yield that's guaranteed longer term for 10 years. I'd rather lock in a 4.3% rate for 10 years. I know I'm going to get paid that coupon for 10 years. Whereas if I buy a 2-year bond, yeah, it looks great today at 4.5%. I'm going to make more money in for the next 2 years. I've got that locked in for 2 years. But when that contract expires after 2 years, that bond matures, then what? Now I have reinvestment risk. And so people aren't buying rates where they are today. And that's why the yield curve is inverted. And popularly, most people know that an inverted yield curve is the number one predictor of a recession. And I don't mean to make this conversation all bearish and all recession mongering,
No, this is
but
great, guys. If you're an investor, you want to be investing in times like this. Like, this is the perfect time to do so. So you should be excited about this.
yeah, that is true. There's so many elements to the game and there's so many ways to look at it, but that is absolutely true. And we've had the yield curve inverted for quite some time. I believe we're now heading into the 19th month of yield curve inversion. And I believe the average time between the yield curve first inverting to a recession being announced, the average time is 18 months. So we're right here in the mix of things where we're right on track, we're right on schedule. We're supposed to have a recession. We raised rates to a very high level that has constrained the economy, and it's our time. So that's what the
This
yield curve is telling us.
Yeah, and this is the tightest spread I can remember since the yield curve has been inverted, since I've kind of really been looking at it every day. 26 basis points. That's very close to kind of unwinding itself.
Well, what's interesting is the 5 to 10 has uninverted,
Yeah.
right? So we're on our way to
Yeah.
actually getting there. So I don't remember exactly what the different maturities mean as far as uninverting, but that is something that has been noteworthy that the 5 year and the 10 year have now uninverted because those have been inverted. Everything was like this, but now it's starting to unsteepen and then the 5 year is coming down, which is great for us because we're 5 year debt borrowers. That's what we've been primarily doing is borrowing 5 year money, 7 year money as well. And there's not really much of an index rate difference between 5 year and 7 year money, but that's definitely great for us.
Without a doubt. Well, for everyone who's been listening to this show, we appreciate you attending and being here. If you have any questions pertaining to our deals, our deal flow, what it's like working with us as a limited partner, LP investor, passive investor, or a capital allocator with us, don't hesitate to reach out. And if you want to learn more about our event and if you'd be a good fit for our event, please reach out to my email. It's Craig at LSCRE.com, CRAIG at LSCRE.com. For all those that are here today listening, thank you so much, and we'll see you next week.